The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The curse of high expectations. Live from Studio 2 here at Bloomberg headquarters in New York. I'm Romaine Bostick.
And I'm
standing
Katie
way back
Greifeld.
from me here.
You know, I wanted to look like, I don't know. Anyway, let's talk about the market and what's going on this Friday. It's really quiet, actually, after the very action-packed short week we had. The S&P 500 higher by about 0.1% if you're feeling generous. That's not going to be enough to bring us into positive territory for the week. You take a look at the NASDAQ 100, your slight outperformer today, higher by about 0.4%. The small caps pour one out. The streak is over. The Russell 2000 down by about 1.8%. And then you have the bond market very well behaved on this Friday. The 10-year Treasury yield just about unchanged, Romaine.
Yeah, interesting price action today because despite yesterday posting its best two-day daily gain since November, the S&P now headed towards its worst back-to-back weekly loss since June. The spike in volatility this week and the spike in political chaos. It was actually great for tactical traders and for scalpers out there, but not so much for anyone else.
When valuations are full and unexpected events and news come in, everybody takes a pause and reassesses.
And if you want evidence of the jitters that popped up this week in financial markets, pay less attention to equities and maybe more attention to what's been going on elsewhere. The relentless record rally in gold and silver continues unfettered. Oil prices ticking up for a fifth straight week, the longest streak of gains since 2023. And that modest strength in the dollar to start the year, that's now flipped to weakness. The Bloomberg Dollar Spot Index posting its biggest weekly drop since last May. And if this week was all about geopolitics, next week promises to be more about, corporate fundamentals. And that might not actually necessarily be a good thing. Expectations were high coming into this earnings season, but a slow start out of the gate has actually curbed the rate of those EPS upgrades that we have been seeing for some time. A big test for bullish conviction next week. 103 of the 500 largest companies are reporting. UPS, Boeing, SanDisk, GE, Vernova, and Starbucks, and four of the 10 biggest market weightings, Apple, Microsoft, Tesla, and I'm sure your favorite, Meta.
I am psyched overall for this earnings season because, of course, we're going to be talking about the fundamentals once again of these companies, but we're also going to be talking a lot about CapEx spending. That has been sort of the boogeyman over the last few reporting seasons when it comes to a lot of these major AI names. So take a look at this chart behind me because this is exactly what we're talking about. When it comes to the hyperscalers, you're taking a look at their planned spending, and for the first quarter of 2026, it's expected to clock in at over $500 billion. And you can see really this waterfall, I guess to the other direction though, this building wave of CapEx that has been building over the past several years. I mean, you compare that to where we were 10 years ago, Romaine, it is a totally different story. There's a lot of concerns about what's going on the right hand of that chart right now and whether or not all of those investments are actually going to pay off for investors.
Yeah, well, let's find out if we should go chasing those waterfalls. Ayako Yoshioka joining us right now, Portfolio Consulting Director over at Wealth Enhancement. Great to have you here on the program.
Great being here.
Let's start to talk a little bit more about not just the AI trade, but really in the context of some of the earnings that we're going to get. I know there are a lot of people that are still, certainly longer term, still have a lot of conviction in this. But when you look at valuations for some of these publicly traded companies, are they still opportunistic in terms of being an investment?
Sure. So when you look at the overall market, so if you look at the S&P 500 as a whole, it's trading at 22, 23 times. But the growth rate has been there, so it's expensive. We know that, but on a PE to growth ratio, it's actually not that bad. It's in sort of where it has been in the past. And so when you look at the specific companies, a lot of the tech companies that are there, their valuations are rich, but they're relatively fair for the growth rates that you're getting.
Is there been, I mean, we were talking the last, 14 sessions or so about the outperformance of the Russell 2000. Even when you look at the S&P this week, it's down, but you still have meaningful gains in energy and materials and areas that aren't tech, aren't financials, if you will. Is that actually a healthy sign of what's happening in the market?
Absolutely.
Mm-hmm.
I think we were waiting for so long for the broadening out trade to really happen, and we've seen it over the last few months. And, whether it was small caps or international stocks, you're actually getting outperformance in other areas of the market, and that's something to cheer for sure.
Something to cheer for sure. Is it something worth chasing at this point? Because a lot of those stories when it comes to the international markets We've been telling them for at least a year right now. So how much steam, how much juice is truly left when it comes to that trade in particular?
Sure. When you dissect it between multiple expansion and earnings growth, we still think that there's going to be pretty decent earnings growth, especially in emerging markets relative to developed international. But their earnings growth is going to be there, and that's what we are counting on, similar to what we're counting on in the S&P 500 and the overall earnings growth. So you never want to chase just that multiple expansion, but we do think that earnings growth is going to be there.
And I do wonder what the shape of the trade looks like, whether or not, if we continue to see international markets, particularly EM, continue to perform. Does that come at the expense of the U.S., or can those rallies coexist happily?
I think, as you saw last year, they can coexist pretty happily. However, I think it's just a matter of which one's going to outperform the other, and that one's a little bit harder to discern.
What did you make of, I guess, for lack of a better word, some of the political chaos that we saw this week? But specifically in the context of the impact on the market, because usually we're told look, a lot of this stuff really doesn't matter for the market. There may be some short-term knee-jerk reactions, but on the whole, it doesn't. Did you get scared? Did you get worried at all?
I think we have fielded a lot of questions, but I think a lot of clients have gotten used to some of this political noise, and last year was a great example. You saw that we almost had a bear market in the S&P 500 after a lot of the tariff noise, and we rallied back. And so I think there's a little bit of that dip buying mentality going on, and I think that's why you saw a bounce back on Wednesday this week after the down day on Tuesday.
And that gets to this idea, though, too, like outside of equities, there are a lot of conflicting signals about how people view the state of the economy, the state of political affairs, and the state of markets. You look at what's going on in the commodity space, the softness in the dollar, and obviously, even though I guess the volatility's come down in treasuries, there's still a lot of sort of, I guess, jitters, for lack of a better phrase.
Absolutely.
Yeah.
I think on Tuesday, when markets were down and everybody was so focused on Greenland, I think some people maybe forgot that there was an issue in Japan, and Japanese long bonds were going up because of the proposed tax cuts. And so I think there's a lot to be said in terms of monitoring the bond market to see where that volatility is coming from, because we don't want that credit stress in the bond market to then spill over into the equities.
Well, give us a little bit more on what you are monitoring. I mean, are you taking a look at the 10-year Treasury yield? Are you taking a look at credit spreads and trying to map the stress, or is it some sort of combination?
It's a combination, and we look at the correlations as well between equities, stocks, and commodities, just to see how everything is sort of interplaying with each other, and across different time frames as well. Because we know that sometimes on the one day everything sort of correlates all the way to one, and on other days, when over longer time frames, so 3-month rolling or 3-year rolling time frames, the correlation is a little bit better, and you want that hedge.
Mm-hmm. Well, what do you make of the correlations as they stand right now? Because I know one day doesn't really tell you that much, but I think about what happened on Tuesday. You had equity markets puke, for lack of a polite word there, and then you take a look at what happened in the bond market. They were no help as, you think about the stress in Japan. So, I mean, when it comes to that correlation and that 60-40 hedge that's supposed to exist, can you rely on the bond market?
I think everybody's packaging all of this into the Sell America trade, and I don't necessarily think that that's the accurate sort of narrative to be had. However, there are a lot of cross currents to monitor, and you've got to make sure that, why is that investment in your portfolio? And I think that's what it comes down to at the end.
So when we talk about just sort of the opportunities going forward, and I want to talk a little more longer term, particularly given the types of clients that you deal with, are they still kind of just focused on those gigantic structural themes that we always talk about, and not just AI, but obviously issues with demographic changes, longevity, things like that? What is like kind of the big focus?
Sure. I think in terms of focusing on the long term, you have to focus on some of those long-term trends. So whether it's AI and that physical build out, how long does it continue? Who are the beneficiaries who are truly using AI and getting that productivity? I think we're having some more conversations in that realm now versus just the overall infrastructure build out. Mm-hmm. And then the demographics for sure. I think, we're seeing such a change in the overall interplay across the globe and all the different countries, and things are just different now than they were 5 years ago. So we're really seeing a lot of differences in the conversations that we're having with clients.
And before we let you go, I am curious what your client conversations sound like as it relates to who might be the next Fed chair. The headlines coming hot and heavy. It seems like BlackRock's Rick Rieder has moved into pole position. What do clients want to know?
I think clients aren't as concerned about who the Fed chair is. I think that's more of a concern from our standpoint on our investment team. And Rick Rieder would be a great Fed chair. He's got some great market experience as well as just the overall understanding of the fixed income market. So I think that would be a great choice.
Always great to talk to you. Great to see you.
Thanks for having me.
All right, we'll let you get out of here before the storm hits here in New York. Yoshioka, Portfolio Consulting Director at Wealth Enhancement, kicking us off to the close. When we come back, we're going to talk about innovation in the tech sector and where the next chapter of it comes from. Tony Fadell, the principal at Build Collective and the father of the iPod and iPhone. He's stepping in just a second.
And from reimagining tech to reshaping the asset management space, acquisition news coming out of firms Janus Henderson and Richard Bernstein Advisors. We'll discuss with the latter's founder.
And we're going to continue to look at the future specifically of media and tech for that matter, as that ByteDance TikTok deal is finally firmed up. We're going to talk to the former U.S. CEO of that, now co-CEO over at Candle Media, Kevin Meyer. He joins us in just a bit as well. Stick with us. A lot more coming up here on The Close. This is Bloomberg.
Well, risk of a short squeeze in shares of SanDisk has reached extreme levels. That is according to a new analysis from S3 Partners. Short interest in the top performing S&P stock of 2025 is up substantially since November, now hovering about 7.5% of the float. Joining us with more on this is Carmen Reinicke of Bloomberg News. So, Carmen, this has been a very painful short. Are we able to quantify just how much money these bears have lost?
Yeah, so it has definitely been a painful short, especially if you are on the bearish side here. So we're seeing mark-to-market losses at around $3 billion. That's data from S3 Partners LLC. And really what we're seeing here, SanDisk shares are up more than 550% in 2025. It was the top performer on the S&P, and that's continued to go this year. So shares are up more than 100% year to date. So a really incredible run. And we're seeing short sellers say, you know what, we think it's going to come down, and increasing their bets that it will reverse, even though the stock kind of keeps continuing to climb.
Is SanDisk alone in this, in the way investors are looking at some of these memory chip companies, or are you also seeing similar short interests on some of their peers?
It's definitely not alone in its outperformance. So the top stocks of last year were Western Digital, SanDisk, Seagate Technologies, and Micron. And I think, we are seeing increased short seller interest across the group. Really just this idea that some of these stocks have seen really astronomical gains, and they won't just keep going up and to the right forever. So even though these companies are set to be some of the biggest beneficiaries of CapEx spend, all of this is cyclical. As the AI trend kind of keeps continuing and building out, there will be other stocks that become winners as well.
Well, you take a look at SanDisk shares up over 1,200% over the last year or so. I mean, it's just been amazing to watch this name run. We are heading into SanDisk's earnings next Thursday, Carmen. I mean, might that flush the shorts out, or what is the setup as we head into that important print?
Yeah, I think that's a really great question. Something we do see a lot before earnings is sort of this idea of, buy the rumor, sell the news, so stocks can run up ahead of earnings results and then, sell off once we get that news of, what happened in the quarter. I think for so many AI stocks, really what people will be focused on is their guidance, what they're expecting in the coming quarter, the coming year, and really how much they're seeing in terms of demand, right? Are they still seeing incredible demand for memory storage from the hyperscalers?
Well, I mean, speaking, I guess, of, kind of guidance, I don't know if you've seen Intel shares. They're down 18% here on the day. And it gets to this idea of a company that at least seems on paper to potentially have some demand, but doesn't necessarily have the ability, at least right now, to meet that demand, whether it's their production issues and those snafus, whether it's the cost, memory for their PC business and how that works into it. I am curious about this idea of the execution that these companies have to have. It's one thing for everyone to come knocking at your door and say, we want what you got, but you got to be able to deliver it.
It's so true. And actually, that's something that I hear from investors is one of the concerns. Even if these companies are set to gain, they have big backlogs, they have these products ready to roll out, bottlenecks are an issue. That's going to be something that's going to add volatility to their stocks as we go forward. And so Intel is a really good example of that today. We're seeing shares off so much. I mean, it's $50 billion in market cap that's been erased from this stock just today. And, it's because they're not seeing some of the products entice new clients like they wanted to. So something that led to the run up ahead of earnings was some of these rumors that they could have new clients for Foundry, and that's not something that they really delivered on or were able to give investors, sort of the confidence that they wanted to hear.
All right, Carmen Reinicke of Bloomberg News, a closer look here at what's been going on in the broader tech space, specifically when it comes to the AI trade and the components that go into it. SanDisk, of course, reports earnings next week, as does Seagate and Texas Instruments. When we come back, we're going to focus in on, the food sector and consumer spending for that matter, too. Darden getting a pair of upgrades today. We're going to talk to one of the analysts behind that change and why he's actually getting a little bit more bullish on the casual dining sector. That conversation up next. This is Bloomberg. Time now for our top calls. A look at some of the big movers on the back of analyst recommendations. And we start off today with Sherwin-Williams. Deutsche Bank downgrading the paint company to hold, trimming the price target to $380. The firm says expect the challenging demand environment to continue, potentially for the rest of the year. The shares down 1% on the day. Next up, Spotify, Goldman, boosting its rating to buy. The price target nudged down to $700. The analysts saying that the music streaming platform is well positioned to benefit from rising AI adoption. Those shares up almost 3% here on the day. And finally, Darden Restaurants, Olive Garden, Longhorn, two of their biggest brands. That company getting an upgrade today from Mizuho and over at Milius, over to outperform. Mizuho also boosting its price target to $235 from $195, saying that Darden will be a beneficiary of tailwinds that will drive the casual restaurant sector higher. Those shares up fractionally on the day, and those are some of our top calls. And we stay on that last top call with Nick Setyan. He's Managing Director of Restaurants Equity Research over at Mizuho. And Nick, I am curious here as to what, if anything, has sort of changed over the last few months. I was kind of looking back to like early last year, where it seemed like so many analysts were kind of dour on the casual dining space. But it seems like you, along with a few others, have actually started to see maybe a little bit more of a silver lining as to what's going on. What is going on?
Going to 2026, casual dining is in prime position to benefit from some of the fiscal policy we're going to see, particularly from the big, beautiful bill. The incremental tax refunds, that's $90 billion just for that middle-income consumer alone. That should drive a healthy consumer, particularly for that casual dining segment. We have World Cup coming up in the summer, which could be an additional driver as well. And ultimately, they just haven't taken as much pricing as QSR. And so they are, as a segment, casual dining is taking share from QSR, which has taken over 40% pricing over the past 5+ years or so. Casual dining has taken pricing more or less in line with grocery. So they're not seeing that sort of share shift away from them the way QSR is.
With regards to cost, because that was a big part of the story as to why some investors got a little spooked last year, was with inflation and a lot of the input costs, both in terms of food costs as well as labor costs. Is that a little more under control, or at least a little bit more stable?
Well, it's certainly a lot more under control. Beef has been the outlier. We've seen a lot of inflation in beef, particularly in 2025. That does seem like it's going to be less of a headwind in 2026. And again, relative to other segments like QSR, casual dining is favorably positioned with respect to inflation as well, because they don't, as a group, have as much exposure to beef as, say, the QSR burger players.
And Nick, you think about some of the different levers that these restaurants and these fast casual chains can pull. Pricing is one, but then there's also been conversation around portion sizes and whether or not we're seeing portion sizes sink at certain chains. And I'm wondering what sort of trends you're seeing emerge there.
Well, certainly, for example, Darden, we're seeing them, introduce smaller entree sizes across 7 or so of their entrees. You can still get the full size entree, but now you have the option of paying a little less and getting a smaller entree. That's intended as both a value option, but also as potentially an answer to some of the weight control drugs out there as well. And so we're seeing that as a potential answer again to on both of those headwinds, potential headwinds.
That's interesting, Nick, because my question was going to be, how are diners receiving that? I mean, you think about sort of the human reaction of, I'm getting a smaller size, but it sounds like, the way you're phrasing it, a potential answer that maybe this is a reasonable move for these restaurants to make.
Well, they're certainly not taking away your option to get the full-sized entree. So you can still pay, the higher price and get the full-sized entree, but now you have the option of potentially trading down to a smaller-sized entree at a lower price.
So give me some sense here, Nick, as we kind of move forward deeper into this year. Is Darden itself, is that a growth story, or is this just more like things are stabilizing, things are going well, they're going to be able to generate enough cash to keep investors happy? Or are we going to start to see the executives and the CEO articulate a little bit more of an expansion strategy?
We look at Darden as the primary compounder within that casual dining segment. You have mid to high single-digit top line growth year in, year out, pretty high visibility into such a growth rate with some, leverage and share buybacks. You get to high single-digit EBITDA growth and low to mid-teens type of EPS growth year in, year out. So, the question really isn't whether they're going to miss those numbers over any, period of time. It's whether they're going to come in at the high end or above, or at the low end or the midpoint. We think over the next year or two, they're poised to come in at the high end or above those long-term targets.
All right, Nick, really appreciate your time on this Friday. That is Nick Setyan. He is Managing Director of Restaurants Equity Research over at Mizuho. It's going to be really interesting to get into some of these restaurant names and names such as Starbucks, for example, reporting next week, which I know you're following closely.
Yeah, we're following that closely, and it gets to the idea because it's obviously it's a corporate story, but it's also a consumer spending story. It also says a lot about consumer preferences as well. I know, for example, you were big on what was it, the protein foam?
Oh yeah, the protein lattes, protein foam.
But did that really have an impact on sales? I mean, according to Starbucks, they're like, oh, well, maybe not.
I guess we'll find out. I mean, it feels like every single chain is getting into protein somehow, so it's going to be interesting to see if that actually is the move. Fiber is up next. I hear that's coming back. But anyway, we'll keep you abreast of all the trends. Coming up, the iPod, the iPhone, the Nest thermostats. Odds are you've used at least one of these products. We'll speak to the man who helped invent them, Tony Fadell. He is principal at Build Collective. He joins us next. This is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. That's the J.P. Morgan building. I'm Romaine Bostic. You cannot
get enough of it.
It's bothering me.
The J.P. Morgan building?
Yes, it is.
Okay, well, maybe we can talk to someone about that. I'm Katie Greifeld, by the way. We're keeping an eye on the J.P. Morgan building, the markets, and another C-suite shakeup this week with Apple expanding the role of hardware chief John Ternus to include design work, potentially solidifying his status as a top candidate to succeed Tim Cook as CEO. Joining us to discuss is the man behind the inventions of the iPod, the iPhone, Nest thermostat, and much more. His name is Tony Fadell. He is principal at Build Collective. He's also the author of Build, an unorthodox guide to making things worth making. Tony, it's great to see you on set.
Great to be here. Thanks, Katie.
Let's start, I mean, there's so much to talk to you about, but let's start with AI because, you think about AI and it being infused in everything. I mean, you and Romaine were having an interesting tangent before this program started that you think about the state of AI when it comes to hardware that we use. You think about phones and everything else. And I just wonder where that's going. And in your view, I mean, what sort of do you think is the path to having it actually be a bigger part of our lives beyond just chatbots?
Sure. Well, back in 2011, when we actually introduced the Nest thermostat, we had AI in it. We just couldn't say it. So AI has been around the world for a long time. It just became a big thing about 3 years ago. And now we're seeing really AI in the data centers and much more powerful models. It's now moving back to the handsets. It's going to be coming. It's still not there yet, but hopefully Apple is going to be able to do that because they actually have AI engines, hardware engines on the hardware if they get the software there. So I think it's starting to happen because it has to happen because it's much cheaper to do the compute locally where they don't have to build more data centers and they can make it available and much more quick to operate.
It's a great point that you think about, what we talk about as AI today. A lot of this is rebranding. To your point, AI has been around and tangible for a while now. But when you think again about, it being in some of the devices that are glued to our hands in a lot of cases, are you surprised that it's not more ubiquitous at this point?
No, actually, I'm not, because what's happening is we have these bigger is better in terms of the models, and that's not actually what the consumer needs. They don't need to go and do chemistry analysis on their phones. They need to do simple things. And so what the popular media and where the business is all investing in these really big models, all that stuff, for consumers to actually use these things, it can be much smaller, but the attention, the product details, all those things haven't gotten that because everyone's chasing these bigger data center centric models. And so we're going to see this coming in the next couple of years.
Is the approach that we see here with a lot of the U.S.-based companies, is that the same approach that you're seeing, say, in Asia, specifically in China, and to a smaller extent, Europe?
Well, that's a very interesting question. So what you're seeing is a lot of small models that are almost as capable as the very large models coming out of China. Why? Because they don't have the compute resources. So I always love resource-constrained environments because it brings out more creativity.
Yeah.
And so that stuff's happening, and you're seeing a lot of developers in Europe and the US using those models because they're open source, because they're cheaper to work with than the closed ones now.
Well, I want to go there, too, because we look at all the cash being splashed in the AI space, and we look at the giants in this space, the OpenAIs, Anthropics, et cetera, as well. And I almost wonder if that almost handicaps them in a way, because you think back to sort of the last big tech boom, and just, I know there's a lot of mythology and Bill Gates in his garage, or maybe not his garage, or Steve Jobs and all these people, but there was sort of this underdog mentality to a lot of those folks, that they were sort of fighting the big man, and they had to be innovative because nobody really took them seriously. And I do wonder if, like I said, the people now at the forefront, the Sam Altmans and the Jensen Huangs, are to a certain extent at a disadvantage. I know it seems odd to say they're at a disadvantage, given how much money they've raked in, but I do wonder if that puts them at a slight disadvantage.
Well, first of all, I would put Jensen and Sam in two very different camps. Jensen is really innovating. I think Sam is doing a lot of spraying and praying. He's getting a lot of capital and trying to find a application model where he can actually get success for a revenue thing, kind of like Anthropic. Anthropic is actually getting really tight. Their application is really around coding for the first thing, and they're winning definitively. OpenAI is still a platform. It's not an application. And the best companies are application companies, not platform companies. The last really great platform we've had was Microsoft Windows. And there's been nothing since that. So you always have to target the application.
Well, speaking of spraying and praying, I'm so curious to hear your thoughts on what's going on when it comes to the tech talent wars, if you want to call them that, because some of the packages that we're seeing handed out are just mind-boggling in terms of the dollar signs there. I mean, you think about that allocation. Do you think that, that is money being spent wisely, or are we at a place where it's just who can command the most and where?
I think, we saw a little of this in the early 2000s with Google and then Facebook, now Meta, when they were trying to get at talent. Now it's really gone crazy. And I wish I could say that, it makes any rational sense. It doesn't. I would love to be an engineer back then. It's like, wow, you don't have to be an executive and wait 20 years to get those kind of packages. But I think that's just a moment in time. I think that's going to all get readjusted. And maybe some of those companies actually can't pay those salaries long term.
Wow.
They're going to have to re-contract them.
I do want to just go back to the hardware side of it, given your background, and also given the idea of kind of the maturity of the iPhone, and for that matter, the maturity of the Android phones, and kind of where you think the next iteration of devices is. Is it going to be even a phone? And if so, I mean, what does that look like, and who do you think is actually maybe making progress towards actually introducing that?
Well, the thing is, we have so many devices. We have a plethora of devices, watches, rings, glasses now. So that kind of suite of things on your person has been really filled out. And so now it's about software models that actually takes advantage of all that input and output, the data and the sensing and the output, to be able to use it wisely, to be more like the movie Her, and trying to make that happen. But that takes a ton of software. And that takes a ton of software, not just the LLMs we're hearing about, but other types of AI to make this all work together. All those devices should work together.
Does Apple have that, or is it going to be a software company out there that ends up maybe leapfrogging the giants of today?
I think only if you have enough of that hardware suite, the rings, the whatever it is, can you get enough data to inform the AIs to get better and better to allow them to put back onto these devices? Because it's not just one mode of one device that you use. It depends on the mode of use. So if you're on a plane, a train, in a bus, walking, you're in office, you're in home, it's a very different context and a different type of device you might be using, and a different set of data that you're collecting. So you really, it's not going to be a one-size-fits-all. The smartphone is incredible, and the thing to understand is that the best way to visualize visual data is with a screen. It's not through your ears. And so you'll say, oh, we have AirPods and now we can do a bunch of voice. But when you don't want it to describe a map, you're going to bring out your phone and you're going to look at it. So it's more like the old keyboard and mouse and it's going to be like that. Now, obviously, the applications are going to get better and much more voice-centric. But we have to wait for all of that. And it's not just necessarily a new device.
And Tony, before we let you go, you said it was recently as July that when it comes to Apple, they need to get bolder when it comes to AI. It's only been a couple of months since then, but you think about the last few months of progress. Have you seen anything that would make you feel a little bit more positive there?
Well, first thing, they did a big deal with Google, right? Last week, I think it was. And so that's a great first step. I'm hearing bubblings and rumors, smart cameras coming from Apple for the home, various other kinds of smart display in the home. So I think it's coming. It's bubbling up, but it takes a while to you don't just turn those companies on a dime. So we'll see, hopefully.
Do you still talk to people at Apple?
Absolutely. I was talking to some people this morning.
Okay. All right. Fair enough. You want to tell us what it was about?
we were talking about Vision Pro.
Tony, great to have you. Real pleasure.
Thank
Tony
you.
Fadell, principal over at Build Collective and the author of the book Build, and of course, instrumental here in the iPod and iPhones that you carry around. Coming up here, Factor Friday, Chris Cain, he's on deck. Stick with us. This is Bloomberg. The S&P 500 setting up for its first back-to-back weekly loss since June. Markets closing out a volatile week. So let's get you set up here and the week that was, and maybe a read here on what the week ahead looks like. It's our Factor Friday feature with Chris Cain of Bloomberg Intelligence. Chris, let's start off with the traditional factors where I think last time I checked, Katie Greifeld, 23 days into the new year. So I think that's long enough here to kind of start and see how things are going.
Sure. Yeah, I mean, as far as traditional factors, it's really value momentum that has worked. I would call it a continuation of what has happened in 2025, especially late 2025. So you have, the cheap stocks beating expensive stocks by about 3%, high momentum stocks beating low momentum stocks by about 6%. I'm talking about in the U.S., large cap indices. Momentum was the strongest factor in 2025, and in value was very frustrating throughout 2025. But then all of a sudden in November, December, it really started working. So that has continued. The factor that is not working is low volatility. That is, typically, what quants do is long low volatility stocks, short high volatility stocks. The opposite has been true, and that was all 2025, so far in 2026. So that's really causing a lot of, losses for some of these quant funds.
Let's talk a little bit about a streak that just broke today, and that is what's going on with small caps. They were outperforming the S&P 500 for 14 straight days. I believe we hadn't seen that since the 90s. Again, that broke today, but what can you tell us about the performance that we've seen so far and what the near future looks like?
Yeah, it's been quite a run. Small caps are up, I think, 7 or 8% this year versus about 1% or so for S&P. So it's been a huge outperformance. The trend is very strong. The only thing is it is very overheated. So, we did a study where we looked at daily RSI values, that's relative strength index, which is like a technical analysis indicator, going back 20 years. And basically the idea with RSI is high RSIs mean overbought, and that should lead to lower near-term returns, and the opposite with low RSI, and you do see that. So the current RSI for the small cap index is at the highest decile of history. that is correlated to about a flat return over the next 2 weeks. Contrast that with the lowest decile of history at RSI has led to about a 1.4 average return over the next 2 weeks. So we're not saying that the rally is going to, change or anything, but we were saying maybe a breather, a little bit of a pullback because it's very overheated.
Is it possible that as we get deeper into earnings season and we start to get earnings out of those smaller companies, that we actually see a pick back up? Because wasn't that what kind of held a lot of these stocks back, was the idea that they just didn't have profits, or at least
Absolutely. Yeah, absolutely. I mean, people don't really realize about 40% of the small cap index is unprofitable, right? So it's a lot of unprofitable companies. But yeah, I think once the earnings start coming through, we could see a resumption of the rally. But again, over the next 1 or 2 weeks, we could just see a pause, but could be very, healthy.
All right, Chris, gotta leave it there. Great to get some time with you. Good luck with the snow. That is Chris Cain of Bloomberg Intelligence. Yes, it's going to snow a lot, theoretically, on Sunday.
Theoretically.
Are you psyched?
Yeah, actually I am. I'm going to go home tonight and do nothing.
I love that for you.
Yeah,
well,
absolutely.
the snow doesn't start until Sunday, so you've all of tomorrow.
I plan to go skiing on Sunday.
Oh.
You can join me.
Good luck.
Yeah.
I'll be okay on my couch. Coming up next, we're going to take you to the closing bell with Jeff Mills. He is Chief Investment Officer over at Bessemer Trust. He joins us next. This is The Close on Bloomberg.
We still think that there's going to be pretty decent earnings growth, especially in emerging markets relative to developed international. But their earnings growth is going to be there, and that's what we are counting on, similar to what we're counting on in the S&P 500 and the overall earnings growth. So you never want to chase just that multiple expansion, but we do think that earnings growth is going to be there.
Hi, Yoshioka over at Wealth Enhancement, kicking us off to the close just about 10 minutes ago. A somewhat slow start to the earnings season here in the U.S., but it's going to pick up next week, certainly in terms of volume. Whether it's going to pick up in terms of the results remains to be seen.
Yeah, absolutely. A lot of big question marks out there as we get into the heart of earnings season. Let's take a look at where we stand right now, though, minutes away from the close. You can see the S&P 500 trying to hang on, but in a way, it doesn't matter. We know that it's going to be another weekly loss for the S&P 500. The NASDAQ 100 slightly better, and we haven't seen this in a while, Romaine. The Russell 2000 down by 1.8%, underperforming in a big way those large caps.
Yeah, and that's kind of interesting, too, because there was really no direct catalyst for it. It wasn't like some economic data point or something like that. It's just, I guess a lot of people just kind of maybe are obviously selling some of the winners that went along here, but maybe just trying to guard against maybe a potential disappointment next week.
Yeah, absolutely. I mean, you think about the streak that was being built, though, 14 straight days. I believe that was the longest streak since 1996. It makes sense that maybe a few people wanted to take profit on this Friday.
Absolutely here, but maybe things shift next week with more than 100 companies, mostly larger cap companies, reporting earnings next week. Here to get a read here on the market moves on the week and maybe what to expect in the weeks ahead is Jeff Mills, Chief Investment Officer over at Bessemer Trust. He joins us here in Studio 2 in New York. Jeff, first, I just kind of want to start off at the beginning of this week because we saw a lot of chaos, a lot of disruption. People kind of rattled by geopolitics. Then things kind of settled down once they started to look at earnings, started to look at some of the economic data that showed still relatively solid economy here. What does that sort of set up into next week when we're going to start to hear from the biggest of the biggest companies, your Metas, Apples, et cetera, and what they have to say?
Yeah, so you'll clearly get a read-through to a lot of really important things next week. Microsoft, for example, so what's going on with Azure? Are they going to be able to get back to 40% growth? That's a good read on enterprise. Just CapEx in general, a read-through to NVIDIA. But I'm going to be looking at other names as well. Lam Research, what does that mean for semiconductor equipment companies? IBM for services and consulting. So you're going to get a lot of information next week. But I don't think investors should get too distracted by that because, to your point, I think you see a broadening out of both economic growth as well as earnings growth. You have this combination of factors, whether it's improving housing, fiscal stimulus, monetary policy stimulus. It's a long list that should help support this broadening in earnings growth that everyone's talking about, but I actually think will come to fruition here.
I'm curious, though, too, when we talk about the broadening. A lot of investors, they started to look, at least in the AI trade, they started to look for, beyond the NVIDIAs and Microsofts of the world. And we saw them pile into a lot of names. But there's sort of pitfalls to that. Intel is probably a great example of that. I think a lot of people saw a promise there, and then the reality hit last night. It's not that Intel isn't going to be able to maybe show and prove, but we know that it's going to be a much harder road. And so when you look at these rallies and SanDisk and all these sort of ancillary players, are expectations appropriate, if you will?
Yeah, I think for a stock like Intel, for example, maybe not. I think a lot of fast money came into that name. They were looking for some big customer announcement around the Ohio fab. Didn't necessarily happen, but I think there are actually really good individual company opportunities that are just taking the AI tech and using it in their businesses to drive actual growth and efficiency.
Like what?
We added a name to a portfolio, XPO, recently. So they're a less than truckload shipping company. Over the past couple of years, they've increased their earnings per shipment by 25%, where the rest of their competitors have actually moved in the opposite direction. So it's not even a one-size-fits-all across a pretty niche industry. It's how is management of a particular company able to integrate the tech and then actually drive earnings. So company-by-company analysis, I think, is really important right now for investors.
That's really interesting because, again, XPO, that is very much not a tech name. So when you think about some of those other single company opportunities, I mean, do they tend to fall into any one sector or industry bucket, or is it really dispersed at this point?
Yeah, it's almost like a brand new research vertical that cuts across everything. So we look at healthcare, Intuitive Surgical, an interesting name. A company as boring as Caterpillar in industrials, they're doing some things that are interesting with technology, but then also clearly a beneficiary of that. A C.H. Robinson, a company kind of similar to XPO, but definitely driving efficiency in their business. So I don't think you can even paint a sector or an industry with a broad brush, and it should be a good environment for active managers.
Well, to that idea.
Can I just follow up on that?
Of course.
Because I am curious. I mean, we talked to XPO a lot and some of their competitors, Mario Harrick, a good friend of the program here. I mean, that's a sector that has always been plagued by this idea of being sort of a kind of a victim to cycles and high costs or erratic costs. Do you really see a true inflection point maybe for the trucking industry that AI and some of the technologies in there can maybe smooth those, not only get them down, but smooth them out enough so these become more year-round businesses?
Yeah, I think if companies use the technology correctly, then that can absolutely happen. I mean, they've optimized routes and other logistics, and it's clearly having an impact on the business. And I think on top of that, just the macro backdrop that I mentioned, it should be a cyclical upswing, hopefully on top of that. So if a company is executing on the technology side, and then they can capitalize on presumably a rapidly advancing macro environment here, at least compared to last year, it could be a reasonably good setup for companies that are executing.
Well, Jeff, I want to go back to what you were saying about, the concept of a new research vertical that sort of cuts across industries. At the same time that you're paying attention to, which specific companies, single names, have an opportunity here, how much time do you have to devote to trying to avoid the grenades of who is actually being disrupted?
You have to do that just as much. It's almost one and the same, right? Because certain industries are going to win and certain industries are going to lose. And even again, within those industries, you have to look at the specific company. So we have to make sure that we're not investing in a business looking in the rearview mirror. We're looking at that business and saying, are they taking the technology and using it to their advantage? There was a narrative last year, very common, everybody knows about it. Google, for example, was that a pitfall? Was it not? Was search dead? Was it not? So the market gives you opportunities when it gets these narratives wrong, if you can lean against it. And Google was a really good example of that last year. And you see that across the market now.
All right, Jeff, great stuff, great insights here. I have to get you back soon. Jeff Mills, Chief Investment Officer over at Bessemer Trust, counting us down to these closing bells with just about 3 minutes to go, closing out a holiday-shortened week, believe it or not, Katie. It's only been 4 days, but it's felt like 8, I think. But it's kind of interesting to see how the market ends the week, given how it started the week and kind of what happened in between.
Yeah, absolutely. I mean, you take a look at where we stand when it comes to the weekly performance, the S&P 500 down about 0.4%. That masks so much volatility. I mean, you think about how we opened on Tuesday and closed. It was ugly out there.
And the funny thing is, I was having a conversation this morning about some of the volatility. If you just pulled up volatility today, you'd be like, oh, what's everybody complaining about? Of course, you have to kind of go back on the GIP a little bit, but it gives you a sense, Yeah,
the day-by-day volatility has been churning, but then you zoom out a little bit and it's smooth sailing, or you could make that case.
Well, on a weekly basis, it's not big tech leading the charge. It's energy stocks, it's material stocks, a lot of cyclical names despite the downdraft we're seeing in small and mid caps. A breakdown of all of the week's market action and a push ahead to what to expect over the next few days, that starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld, taking you through to the closing bell with the global simulcast. Carol Massar and Tim Stenovic join us right now. Welcome to our audiences across all of our Bloomberg platforms. The camera's right in front of you, Carol. As we welcome our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube. It's Friday, Carol, a down day for the market, a flat day for the S&P. But there was a lot of volatility that led up to this, Carol. Where do we go next?
Yeah, and a lot of volume in today's trade, even though it feels like investors are awaiting a slew of earnings, some big names, some big tech names next week. And then you've got a Fed meeting, but nonetheless, a lot of activity, like I said, a lot of volume in today's trade, even though you look at the S&P just up about 4 points.
And not just a Fed meeting, right? We're getting teased the potential for an announcement on who the next Fed nominee will be.
Oh, I don't think we're ever going to get that announcement. We've been promised
I thought it was supposed to
for a
happen
long
before
time.
Christmas.
Yeah, I mean, it's just...
I'm saying definitively it'll come next week.
Okay.
Mark my
Well,
words.
you do know everything.
All right. Place your bets, everybody. The Russell 2000 today, for the first time in 2 weeks, underperforming the S&P 500.
Yeah, and not just by a little, by quite a wide margin today. It's pretty amazing. I mean, it wasn't clear necessarily to me what was sparking this huge outperformance that we've had to start the year. And then you take a look at today's action. It's also not clear to me why exactly today was the day that broke the streak, but nonetheless, it's over.
Yeah, I was going through because, I mean, it's hard to see on a sector basis, but if you look at some of the individual names, there are a lot of the biggest losers today in the Russell 2000 and in that S&P 400 mid-cap. Those had actually been some of the biggest gainers over the last few weeks, so potentially that could be profit-taking, but to Katie's point here, hard to really know one way or the other. We get the closing bells in New York. A down week for the most part for the broad market, but a mixed day with the Dow Jones Industrial Average down almost 300 points or 0.6%. The S&P 500 oscillating between gains and losses, but it finishes the day in the green, up about 2 points. That's basically unchanged. The NASDAQ composite up about 0.3%. The NASDAQ 100 up a similar percentage point. But as you were just alluding to, the S&P 400 midcaps down 1%, Dow Transport's down 1.4%, and the Russell 2000 falling 1.8%.
All right, guys, that is your closing numbers. Let's go back to the S&P 500 in terms of the split. Winners and losers in the Friday trade. And you did see, let me bring it up, 183 names in the S&P 500 actually gaining ground today, Katie. 318 to the downside and 2 unchanged.
Let's take a look at the sector breakdown as well. A real mix here in terms of what did well. At the top, in terms of a percent gain, you had materials outperforming higher by about 0.9% as a sector. You can see tech represented there as well. Consumer discretionary did well. In terms of what didn't perform on this Friday, your biggest loser was the financials, down by about 1.3%. Industrials, too, sort of at the end of the pack here, Carol.
All right, let's get to some of the individual gainers, if we may, on this Friday. Fortinet, ticker FTNT, top in the S&P 500 and NASDAQ 100. That went up about 5.2% in today's session, as high as 9.5% intraday, but still some outperformance there. Rallying on heavy volume after TD Cowen upgraded the security software company to buy from hold. They said AI is not eating security software, but rather augmenting it. Among some of the commentary, price target set to $100. So we're looking at about a 29% increase from the last price. But you can see the stock closing at about 81 and change. Let's move it on over to CSX, as we know, reporting its results. And that one up about 2.3% in today's session. At its highs again, it was up as much as 5%. So finishing off its best levels of the session. The company gave 2026 guidance, including low single-digit revenue growth. Analysts, though, on the company's results saying that CSX still facing a challenging environment amid tepid industrial activity. JP Morgan says the forecast should be enough for the stock to recover from some of the decline that we saw on Thursday. CSX was down 2% in yesterday's trade. And then on an airline, Alaska Air, again, up almost 7% at its highs today, finishing, though, still with a gain above 4%. It did beat Wall Street's expectations, reported strong demand for premium and business flying, though it joined larger rivals in offering a more tepid outlook for 2026. Airline execs offering a wider than usual profit range for the year and telling analysts that the carrier remains at the mercy of volatile fuel prices and potential global shocks after a whipsaw 2025. I feel like geopolitics and concerns around the globe continue to creep their way into commentary among the CEO community.
All right, you got the gainers, I got the decliners. I want to start with Intel. It's kind of yesterday's news, but look at this. It was the most actively traded stock by far today in the U.S. on U.S. exchanges, falling 17%. Did plunge as much as 18% earlier in the session. Lip Bhutan, the CEO, gave this lackluster forecast, warning that the company was struggling with manufacturing problems. Worst single day going back to August of 2024, still up 22% so far this year, up 120% last year, but low manufacturing yields, years trying to restore its tech edge, recover from market share losses. It's a setback for the U.S. government, too. It's trying to rebuild a vibrant domestic semiconductor industry and has made Intel a cornerstone of that strategy. Also, keep an eye on shares of Apple ahead of earnings next week. Shares slipped slightly today, but more so interested in what happened over this week, down about 3% this week. It's its 8th straight negative week, longest stretch going back to May of 2022. It's been down about 12% over the last 8 weeks. And should Apple extend its losing streak next week to a 9th week, this would be its longest streak going back to July 1993. That's according to data compiled by Bloomberg. So we'll see what happens next Thursday.
What are you actually looking for out of those earnings? So, like, I mean, what could even be the upside catalyst at this point?
We talked to Mark Gurman about this. I mean, obviously, everything is about the iPhone still. But given all the concern about Apple's AI strategy and what Mark has reported this week when it comes to that revamped Siri, he wants to see, action there.
Yeah.
We'll see.
We'll see.
And this is an interesting one. Syringe makers actually had a pretty bad day.
This caught my eye. I love these types of stories.
This is really cool.
I had been paying attention to this.
Becton Dixon, BDX, West Pharmaceutical Services, WST. Becton Dixon down 2%, West Pharmaceuticals down 4.5%. They fell because analysts are so positive about the launch of Novo Nordisk's oral Wegovy medication. Check out what JP Morgan analyst Robbie Marcus says. He says bullish comments from Novo on the ramp of its oral Wegovy pill has led to fears of cannibalization from the traditional injectable market. So if people aren't injecting the medicine, they're taking pills, that means fewer syringes, and those stocks take a hit.
That's just logical.
Yeah, I was just fascinated. I mean, it's funny how sometimes you don't think about kind of these kind of ancillary beneficiaries of these rallies. The idea everyone's on Ozempic or whatever, Wegovy, whatever, and they need the syringes, so that benefits the syringe makers. And if they all switch to pills, then what? Won't someone think of Becton Dickinson? Let's go to the yield space, because honestly, not a whole lot happened today. And this actually gets to something Katie and I were just talking about a little bit earlier on the close. The idea that if you just woke up today and kind of looked at some of these markets, you wouldn't think that a whole lot actually happened this week. But of course, we had one of the biggest spikes in bond volatility to start the week. It settled down pretty significantly yesterday and subdued today here. Modest, and I mean really, really modest declines today on yields across the space. Of course, that could change in a big way with some key economic data next week, a Fed meeting on Wednesday, and, as Carol Master believes, a potential Fed announcement out of the president.
Yeah, no, that's kind of where you're coming from. We'll see what we get, because we've been promised that announcement, but eventually he's got to come and do that. Having said that, in the meantime, we're all really focusing on this massive snowstorm that is hitting so much of America. And there's a great story out by the AP, just kind of putting some of the numbers to it. I know you guys have been talking about it. So many Americans are going to be impacted. More than 170 million people, so that's about half the population of the U.S., are in the path of this storm. More than 1,500 flights scheduled to fly through the U.S. airports Saturday were canceled by the time the storm began early Friday. That's according to FlightAware. And then there's some other statistics that really kind of put this storm in perspective.
Yeah, I mean, I think a lot of people are concerned about what happens to power supply, the grid health, grid resilience in many parts of the country, not just here in New York, but also in Texas. Katie, given what happened there 5 years ago, we've seen the way that these different jurisdictions have responded thus far, warning people. But with a storm this big, the big question is, like, where do people go if they are affected?
Absolutely. I mean, it'll be interesting to see if we actually get all of the snow that's being forecast, because the range is quite wide. I do want to point out, it's not just planes. Amtrak's are also getting canceled as well. But when it comes to the airlines, another interesting piece of reporting that apparently U.S. airlines are offering to waive fees ahead of this big winter storm, maybe sort of soften the blow of all the cancellations that you know are going to come.
Yeah, and we should also point out, too, I mean, we talk about just the potential damage that can do. It's not just obviously the amount of snowfall, but it's also the areas where they fall. It's ice, other things, particularly if it does fall in areas that aren't traditionally used to dealing with that, and that always creates a lot of problems. It's interesting, too, to kind of see the various local politicians come out and prepare their residents for what's to come. Still waiting for a little bit more of a national response if it does get to be that serious.
So do you know how many snowplows are in Nashville named after Dolly Parton?
Oh, my goodness.
I'm sorry, after Dolly Parton?
Yeah. Apparently there's one.
Oh.
That's it?
Yeah.
I feel like there should at least be two.
Yeah, exactly. One in East Tennessee named Snowlean after a classic hit song.
I love that.
That's great.
Yeah, that's good.
Pretty clever. All right, guys, do stay safe, do stay warm. That is a wrap. Our cross-platform coverage. We call it the closing bell. Of course, Katie and Romaine are going to continue there on the close on Bloomberg Television. Tim and I continuing on Bloomberg Business Week Daily right here on Bloomberg Radio. Have a good and safe weekend, everyone. We'll see you again, same time, same place on Monday.
It's not M&A Monday, but we do have some big deal news in the financial space. When we come back, our coverage continues with Richard Bernstein, the CEO of Richard Bernstein Advisors, talking about that big deal struck with Janus Henderson. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostick. Another wild week on Wall Street, and it closes out here on this holiday shortened week on a very curious note. The S&P 500 flat on the day, trying to rebound here from some of the early selling in the session. The Russell 2000 not spared, down about 1.8%, the worst day since November, and the biggest underperformance for the Russell 2000 relative to the S&P since April. Of course, that's coming off of 14 straight sessions of outperformance. A big part of the reason is there's still a lot of jitters out there. Spot gold up about 0.9% on the day to another record high. We should point out silver, 5 straight days of record highs, closing out today above $100 an ounce. And keep an eye on natural gas. It's rallied more than 70+% just over the past few days as a deep freeze and a potential crippling ice and snowstorm starts to sweep across the United States.
Yeah, absolutely. We'll see what transpires this weekend, but let's take a look at some of the individual equity movers on the day. I put some good news on the board just to mix it up. You have CSX, Freeport, McMoran, both rising about 2.5% if you add them together. But what I really want to talk about is what happened with Intel. Shares plunging 17%. We know they reported earnings about 24 hours ago. A lot of concerns about spending. It's going to be interesting to see if more of those concerns come through as we get into some of the big tech names next week. But let's get to our top story this hour, and that is reignited confidence in the M&A market. 2025, it was a comeback year for global transactions with momentum continuing in 2026. Buckle up. Capital One agreeing to buy fintech firm Brex for $5.1 billion. You also have TikTok sealing the deal to operate in the U.S. And you also have Netflix's co-CEO Greg Peters telling the FT that it's on track to win backing from Warner Brothers shareholders. Meanwhile, you had nearly $500 billion asset manager Janus Henderson announcing today that it would buy Richard Bernstein Advisors, which adds about $20 billion in client assets. And I'm pleased to say that joining us now is Richard Bernstein himself. He is the CEO of Richard Bernstein Advisors. He'll join Janus Henderson as global head of macro and customized investing. Rich, it's great to have you with us. So you think about RBA. You founded it back in 2009. Why sell here and merge with Janus?
So, Katie, thanks for having me on. Look, I think we've done very well. Our growth has been spectacular, to say the least. But the problem is the asset management industry, to be frank, has become amazingly fragmented, and it's very difficult to compete, right? I'm sure you know as well as anybody out there, there's a handful of monster money management firms. And for a firm like ours, despite the fact that we have tremendous intellectual capital and tremendous products, it gets very hard to compete for market share. And so a firm like Janus creates a very good symbiotic relationship between the products that we have, the intellectual capital we have, with their marketing, distribution, international exposure, and that sort of thing. Exactly the kind of things a boutique like ours can't do. So you get this wonderful symbiotic relationship between two firms that have very common corporate culture, right? We're very research driven. We're very client focused, and so the corporate cultures are matching very, very well. And then you get this symbiotic relationship. It's a very, very, I think, advantageous strategic partnership.
Yeah, well, certainly it's a nice summary of where we're at when it comes to just how fiercely competitive the asset management landscape is right now and just how big some of the top players are. But let's talk about what Janus is also getting by buying Richard Bernstein Advisors. Of course, this acquisition, it vaults Janus Henderson into one of the top 10 model portfolio providers in North America. Explain to us why model portfolios in particular have taken off with such popularity.
Yeah, that's a very important trend in the capital markets and in money management right now, which I don't think most people still appreciate. And that is for the financial advisor, they really increasingly need sort of a one-stop solution for asset allocation. So that could be that there's tax issues. It could be that they don't understand certain markets very well. There's any number of different reasons that a financial advisor would do this. And so we have been very lucky. We've been in that space for quite some time. We are one of the biggest independent model managers that are out there. And so what Janus doesn't have any group like ours. So what we bring to them is that group. At the same time, we can dovetail with the advantages that they bring to the table, like distribution and marketing and those type of things.
How much has technology and sort of some of the advances in technology, specifically in the financial space, how much did that play a role in this, Richard?
So, Romaine, I think technology is always important, right? I mean, remember, I was one of the original quants on Wall Street who kind of learned that the computer would be very helpful in picking stocks, right?
So, I remember when everyone on Wall Street hated people like you, and then they loved everyone like you.
Exactly. Quant was a dirty word, and so exactly. But technology is always important. But right now, where we can really use technology very effectively is in what we hope to do in terms of customizing portfolios. Like I think RBA, my colleagues and I think we have very important intellectual capital. The problem that we have as a small firm is tailoring that to an individual and to an individual's needs. Janus has that critical mass where we can start tailoring individual models. I mean, that's incredible for a firm like ours that we'll be able to do that.
What do you look at when you look at sort of the evolution of money management, certainly the build out and now this huge expansion we're seeing in the wealth channels, the potential of private assets being made more accessible to individual investors and individual investors of a lower net worth. When you look at that evolution over these years, where is that taking us?
So I think that's a very interesting question relative to where we are right now in the markets. I would argue that the need for diversification right now, Romaine, is paramount. People actually don't want to be diversified right now. They want to be, exaggerating here for a second, they want to be in 7 stocks and nothing else matters. Our argument has been that when we have essentially the narrowest market for the longest period of time, longer and more narrow than the tech bubble period, the need for diversification is greater now than probably it's ever been in my career. That's not what people are thinking, right? People think the exact opposite. They think it's easy. And so I think, the point that you're trying to make here with whether it's private assets, whether it's just simple asset allocation, it's really, really important right now and generally being ignored by most investors.
Well, when it comes to asset allocation, talk to us about what diversification looks like in that context. I mean, you think about the bond market right now, it's something I harp on every day, that treasuries, at least for the last couple of years, have been a pretty unreliable hedge. So if you're looking for that diversification benefit, are you really getting it from the bond portion right now?
Right. So Katie, think about the question you just asked me in terms of the boring assets have done very, very badly over the past couple of years. Treasuries are a perfect example of that. And what we have now is in the fixed income markets, to just elaborate on your example, we have credit spreads that are historically narrow, right? And so the argument that we've made is for 2026, boring is beautiful. It's time to revisit these boring assets that really are diversifying assets, but people don't want to be diversified because diversification has become a lead weight on performance. That's why people always get under-diversified during more speculative or heady markets. Is why would I want to be diversified? It's so easy, and if I diversify, it's just a drag on my performance. So I think, boring is beautiful, I think, is a great theme for 2026.
Boring is beautiful. Well, it certainly hasn't been a boring start to the year. Rich, it's really great to get some time with you. Congratulations. That is Richard Bernstein. He is CEO of Richard Bernstein Advisors, but he'll be global head of macro at Janus Henderson. And I'll be talking about this deal in this week's ETF IQ newsletter. So
is it
go
out?
Check it out. It's not quite out yet, Romaine. But
are you going to include segments of this interview in there?
I should. We'll see if we have the technology, if we can get it clipped that fast. But Bloomberg.com/ETF IQ newsletter.
All right, definitely check that out. When we come back, we're going to talk about that relentless rally that we continue to see in the commodities space, specifically when it comes to precious metals, silver and gold up. So too is copper, and God only knows what's going on with oil. That conversation coming up when we come back after the break. This is The Close on Bloomberg. Silver topping $100 for the first time as the commodity extends its record rally. This as investor demand for haven assets intensifies amid a lot of the uncertainties out there around the world. Joining us right now to discuss some of those moves and try to interpret exactly what they mean is Michael Ball, macro strategist for us here at Bloomberg. All right, let's start off. I mean, we've been seeing for months now this jump up in first in gold. Silver joined the rally. Now they're kind of up in tandem here. Is that a true haven bid, or is there something else going on?
No, I think there's a couple of things going on. It's become a very frothy, speculative momentum trade. We obviously had real fundamentals there. We had the accumulation of gold by central bankers, and we obviously had sort of this kind of commodity grab more generally, broadly, as we had the geopolitical situation involved with Trump. And now we see this regionalization of the world now. So things like gold and silver are now kind of an anti-fiat currency move, whereas, again, you're diversifying out of any currency into this, but you're also then taking a premium where you are then insulated from geopolitical risks or disruptions.
Well, that gets to the idea, too, because as we saw these big moves up this week, we saw the dollar, at least as measured by the Bloomberg Dollar Spot Index, have one of its worst days, one of the worst weeks, I should say, in quite some time. And it gets to this idea as to, we've been talking so much in the show about this rotation trade in equities. And I do wonder if there's something afoot going on in kind of the other parts of the cross-asset space, like commodities and currencies.
Yeah, there truly is. I mean, we have now this real need to have the physical stuff at hand, where we can't rely on supply chains anymore. Because not only is a lot of it obviously through China, and we know America-China relationships are sort of where they are, which is, can be ups and downs, but also just basically what Trump has shown now, especially even in the oil markets, is that he's willing to disrupt the physical trade, whether it was the blockade of Venezuela, we're hearing about Cuba today, where it's going after the shadow fleet. So, for example, even places like India now have actually turned to things like nickel to build up their battery storage ability because they can't rely on fossil fuel trade as much as they used to. So everyone is trying to grab these metals. We have the electrification of the whole world, which has been the secular theme. AI came on top of that, which is, added only the gasoline to the fire. And now this is all about national security because all those things equal national security in a lot of ways. So you have to have more stuff on hand.
Well, to focus more directly, on the currency market, the dollar, as measured by the Bloomberg Dollar Spot Index, set for its worst week since May. And then you take a look at dollar yen. I mean, just today's price action has been really interesting. We started the day near 159. Now we're near 155. What is going on, particularly with that currency pair, given that we've been paying a lot of attention to Japan this week?
Yeah, so overnight there was, again, this speculation that the BOJ or MOF was going to step in and basically intervene and, buy up the currency by selling dollars. That sort of subsided. And then somewhere in the mid-afternoon, we had speculation from sell-side desks and traders that the Bank of New York, for the Fed, was doing inquiries and basically asking for bids to get size in the yen, which would obviously be seen as sort of a preemptive move for an intervention. But of course, they've done this before. It doesn't always go one-to-one by any means. There's a history of this kind of things. But along the signaling effect alone can often get them the desire they want. And the fact that this was coming from the Treasury shows that this is a wider concern. They're worried about yen volatility, basically rate volatility out of Japan affecting Treasury curves, and they're worried about the Japanese actually selling Treasuries and then affecting our own financial markets and financial conditions here.
Yeah, I mean, it's fascinating. You take a look at the intraday of dollar yen, it does seem like that signal was received in some sense. And before we let you go, Michael, let's talk a little bit about small caps. We've been talking about it for the past 90 minutes. The streak being over, finally breaking on this Friday. Was there any clear catalyst for why today?
No, I think you guys did a great job covering it. And I think the factor rotation that we've seen all year just needed a breather. I think also you had some upgrades to some of the mega caps in the last 2 days. You had a better NVIDIA story overnight with the China sales. So again, here we are, positioning caught a little long, positioning in some of the mega caps called short. Just sort of a chance going into the Fed week next week to then reposition, be more neutral.
All right, Michael Ball, great to get
Do we
some
get a
time
new
with
Fed
you.
chair next week? You think we get an announcement?
I have no idea.
I don't know. The short list is pretty dang short at this point, so maybe it is next week.
And you're
Romaine has
still
some
not
money
on it, right?
I'm not
Okay,
on it.
all right.
No,
Just
again,
checking.
unless something really changes in the next few days. But Michael Ball, he is our macro strategist at Bloomberg. Good luck in the snow.
Coming up. That's my cue, Gabe
Yes.
Bradfield. We're going to talk about the future of fashion. We're actually going to talk to the man behind these new 3D printed shoes you're seeing all over at Nike. Cornelius Schmitt over at Zellerfeld joins us next. All right, if you want a glimpse into the future of sneaker culture, take a look at your screen there. It's how Nike dubbed their partnership with the company Zellerfeld. The two companies have been collaborating on 3D printed shoes since 2024. But if you want a pair of those Air Max 1000s that you're seeing there on your screen, good luck, because they're already sold out. Here to discuss, well, is one of the biggest tastemakers right now in the world of footwear, the CEO of Zellerfeld, Cornelius Schmitt. Cornelius, great to have you here on the program. First, let's talk about the design of these shoes. They're very striking. And obviously, we're going to get to the technology and the use of 3D printing. But what comes first for you? Is it the design or is it the technology?
So when I actually started Zellerfeld, I was an engineering student. I was in the middle of Germany. I'm a German engineer, and I always loved shoes. And I've been collecting shoes for since I'm a teenager. But there was a point when I realized, okay, everything that I can collect, it's always the same, shoes from 30 years ago, shoes from 50 years ago that are just being remade as retros. And at some point that gets quite boring. And since I studied engineering, I realized, okay, maybe I can do something about it, which is building a machine where just with a push of a button, you can have whatever shoe you want. And that machine happens to be a 3D printer, which absolutely fascinates me still to this day. This is now maybe 8 years ago when I started. And since then, I have been lucky enough to work over time with the biggest tastemakers in the world, and now I finally have what I always wanted, which is just the coolest shoes ever.
So we should point out, what we're seeing behind you, if they put the shot back up, is that's essentially the machines themselves, your farm, if you will, of the shoes. Is that right?
That is absolutely correct. You are seeing 200 printers behind me. They're all self-built. They're all self-engineered. There's no printer in the world that can print shoes. And we are so obsessed with the thought of getting printed shoes on every foot that we actually engineer our machines ourselves.
And so I'm always curious when it comes, to this method of making shoes, whether or not, you're trying to get the athletes, or is this more about, fashion? When you think about getting these shoes on people's feet, is it about looking good or performing well?
It's about both. It is about both, where at the end of the day, a lot has happened since lots of tastemakers are moving towards us. So whatever they bring, we make happen. It's really like a YouTube or a Spotify where you can just upload any design, whatever you want. And some people want to go more onto the function side. Some people want to go more on the design side. We have now celebrities like Justin Bieber, but also brands like Nike, and it's really anyone. And some want to focus on some aspects, some on others, and really whatever you want to do, you can do.
And so you're sort of catering to both there when it comes to form and fashion. When you talk about some of the partnerships you have, you mentioned Justin Bieber, you mentioned Nike. Are those, how do those form? Are you approaching these people, these brands? Are they coming to you, or is it a mix of both?
So the cool thing is, it happened all very naturally. We don't have a marketing department at Zellerfeld. We are basically really just a platform. And what happened is that at some point, very cool people just started uploading stuff and shoe designs where they get very weird in some ways. Like, for example, like we have some kids creators now all of a sudden, and like for example, you see like really a full Lamborghini shoe here, or like, I don't know, like that's probably a chipmunk, and all of a sudden you have just super cool designs where also all of a sudden people are starting to make like real known silhouettes that you might have seen before.
Yeah.
And so what happened is very naturally there has been lots of momentum so that it's a new niche, and especially young people, especially the new generation like me, all of a sudden we cater to them and satisfy needs that otherwise they wouldn't get satisfied. So there is a new market, a new movement, and of course big brands and of course celebrities want to tap into it because it's a market that has never been out there before, which is you can do whatever you want in a shoe, and we think that's quite exciting.
How far do you think you can grow this business as independent? Because I asked that question, Cornelius. You're working with a lot of different brands. Do you see a future where maybe one of those brands says, you only work with us and no one else?
From day one, we have always been independent. We remain independent. What we want to be is really like a Foot Locker of the future. You know, I think the footwear market is kind of broken. Like, I hate that I, as a consumer, have to go into a store. I see 100 designs, 100 silhouettes. They all look the same. They're all boring. And all of a sudden, like, whatever shoe you choose, like, they all don't fit. Like, every shoe, no matter, even within one brand, they all fit horrible and they don't fit me. And in terms of like really fit and not just style. And what I love about 3D printing is what we can do is we have invented something what we call fit profiles. When you go on Zellerfeld.com, you can really just scan your feet with 2 pictures, and we take a custom foot scan of your foot so that we can make basically every shoe that you want, that you see on our website, custom fitted to your foot. And what I believe that will do is, I think all of a sudden consumers will win, where whatever design of those millions of designs that those creators are making, every shoe fits the same. I think that is something that will push us as humanity more towards a future where products get digitized. And in this case, just footwear, you know? Like, this is like a Star Trek replicator. And all of a sudden, we can have whatever shoe you want for, like, your foot custom. I think that is pretty incredible. And I don't believe that there will be shoe stores in the future as this grows. And to answer your question, sorry that I took such a long turn there, I think we can grow this to every single foot on Earth. Like, we very proudly have as a mission statement, we want printed shoes on every foot. We will make our printed shoes so good that everyone will have them.
All right, Cornelius.
And for that, we obviously need to work with every brand.
Yeah, well, we would love to keep in touch on your journey to get printed shoes on every foot. That is Cornelius Schmitt. He is the CEO of Zellerfeld. This is The Close on Bloomberg.
That's it?
That's it. TikTok reaching a timely deal to operate in the United States after years of back and forth about the social media app's future. TikTok and its Chinese parent company ByteDance agreeing to transfer some of their U.S. operations over to an entity that's overseen by Oracle, PE giant Silver Lake, Abu Dhabi investment firm MGX. Joining us live, I'm pleased to say, is former TikTok CEO Kevin Mayer. He is now the co-CEO of Candle Media. Kevin also formerly served as chairman of Disney's direct-to-consumer and international business. Quite a resume, Kevin. It's great to have you with us. We have a lot to talk about, but let's start with TikTok. As I said, this is years in the making at this point. Now that we have some sort of conclusion, would love to hear your thoughts.
Well, it has been a long time. I served as CEO in 2020, and things have changed a lot since then. Back then, the administration was trying to ban the app, went into purgatory for 5 years, and now it's come back out. So I have to say to the guys at TikTok, to my friend Shou Chu, who's the CEO now, well done. It's about time this was behind us, and I think we're all much better served as a result.
And I'm always curious, I mean, I'm a power user of TikTok for better or for worse, and I'm always curious about how the user experience might change. I mean, taking a look at the details of this deal, it sounds like you're in touch, of course, with the current CEO. I mean, do you think that it'll be operated and experienced any differently now under this ownership group?
Well, I don't expect the actual interface to change. It'll be fully interoperable, as I understand it, with the global TikTok, outside of China, obviously. I don't expect there to be a big noticeable difference in any capacity, other than I think the algorithm is going to be retrained on all just U.S. data. That might end up affecting some For You pages in some ways that is really hard to predict. But I do think the table is set for this to be, for all the security issues to be resolved, for users in the United States to be very happy to use the app without any apprehension whatsoever. And I just think it'll be roughly the same. And I think the team in the U.S. is going to see to that.
I am curious, though, too. I mean, we talk about TikTok, and really you can just put all social media in this category, and just the changes in the way that we, I guess, access content and consume that content. And given your past roles, particularly at Disney and particularly in that sort of direct consumer business and the rollout of what is now ubiquitous when it comes to streaming, is that in competition with each other, meaning what we're seeing on that side relative to what we're seeing on the social media side, or are they or can they be complementary?
Well, I think there's a little bit of both. Honestly, that's the right answer. I think that in terms of time and attention, especially younger people, the younger cohorts in this country and around the world, tend to spend more time with vertical videos, social media entertainment, like TikTok, like YouTube, like Instagram. There's a lot of time spent there. And to the extent that there's always contention and competition for people's time and attention, I think that does have a bit of an effect on traditional media, even streaming. However, the use cases are also somewhat different. Streaming services tell long-form stories, traditional television length and movie length storytelling under brands and franchises and characters and IP that people know and love from the traditional media world. That doesn't change. It doesn't completely overlap with what's happening on a TikTok per se. But I do think that over time, you're going to see just a competition for people's time. There's only so many hours in a day.
Yeah.
So that is where these things kind of overlap.
Yeah, and it's a kind of a reminder. We had Netflix earnings earlier this week, and every quarter they always sort of put those clauses in that release talking about who they're really competing against. But it raises a question too, just about the future of these larger media companies, and we talk about, obviously your past at Disney, and of course Disney this week said they are going to finally make an announcement as to who is going to succeed Bob Iger. And my question to you isn't so much who you think it will be, but what type of person do you think it should be to lead a company like Disney, which has such a deep and revered legacy media business, but at the same time has to adapt for what is now a new, more social media forward media landscape?
Look, it has to have a forward-thinking and forward-looking CEO. I think both the candidates that are being talked about, Dana Walden and Josh D'Amaro, both are excellent. They can fulfill the needs at Disney. It's a very highly complex operating company, especially on the theme park side, where Josh D'Amaro's expert. But it intersects with Hollywood and that whole ecosystem where Dana is the expert too. So look, I think one of them will get the role. Disney will be well served by either one, but they both need to be really forward thinking, lean into social media, lean into short form storytelling. Like that hits a company like Disney across the board. People want to interact with entertainment programming in slightly different ways, but especially in the sports on the ESPN side. I don't think a lot of young people sit through most full games anymore. So they sort of ingest and enjoy sports in a different way. So it has to be changed. There has to be a leaning forward into that and embracing that new environment by whoever becomes CEO.
Well, Kevin, I'll ask what Romain didn't. Who do you think will be the next CEO?
Look, the good news is we're all going to find out within weeks, I think. That's the time frame we're looking at here. So the years-long sort of contemplation about this will come to an end. They're going to make the right choice. I think from what I've observed from the process, I think James Gorman is firmly in charge. He did a great job at Morgan Stanley. Whoever it is, it'll be done right. I think they'll try to keep both executives because, as I said, they have complementary skill sets and experiences. It'd be great to keep both of them. I personally don't see a co-CEO role happening there, but I do think that keeping both in the company is important.
Well, speaking of large media companies, I do want to get your thoughts on whatever the heck is going on for the bidding for Warner Brothers Discovery. Obviously, Netflix thinks it has the upper hand with regards to the financial terms of its offer. I think Paramount Skydance thinks it might have the upper hand with regard to some of the other issues here. When you look at what David Ellison is trying to do here and the prolonged fight that he seems to be willing to make to go after that, does that seem wise to you? I mean, who do you think would be a better steward, if you will, of Warner Brothers Discovery and its legacy?
Well, look, that's a good question. They're stewards in different ways. If you want to think about Netflix from their perspective, they'd love to have access, permanent access, advantage access to all the content and all the franchises that Warner Brothers Discovery brings to the table for their streaming customers, and having HBO Max added to the Netflix subscriber base doesn't hurt either. So I think there's a good strategic rationale there. On the Paramount side, scale is all important. That's why these consolidations are happening. Scale in the face of declining revenues, which is happening because pay TV is going away in favor of streaming, which is not as profitable as an ecosystem, as an industry. When at that transition from pay TV to streaming, it's causing consolidation to happen. So smaller subscale players like Paramount need to find scale. So it's urgent for them also. Look, I'm simply surprised that Paramount hasn't upped the ante already. At this point, you'd think that Paramount would have upped their bid to something higher than 30. My gut tells me 34, 35 is what might take it. They're reluctant to do it. There is a price at which it's too expensive, the asset too. So I'm looking for the final stakes to be known in the next, at least in a month, not more than a month. I would expect. And I do think Paramount is going to have to up their bid to be competitive here.
All right, Kevin, really appreciate you taking time for us. Kevin Meyer,
Sure
there,
thing.
the CEO over at Candle Media, former Disney exec and former CEO of the U.S. TikTok business. We want to stay in the entertainment space with the Grammy Awards just about a week away, the 68th annual iteration of the event coming on February 1st. Of course, the biggest nominees there, Kendrick Lamar, Bad Bunny, Lady Gaga. Joining us right now is the CEO of the Recording Academy, Harvey Mason Jr. Harvey, great to see you again here. Obviously, a lot of excitement given some of the nominees who, of course, really stole a lot of the attention over the last year or so. Before we get to that, though, Harvey, I do just want to kind of start off about the importance of the Grammys, not just as a television event, but also as a live event, specifically a live event in Los Angeles, 1 year removed from those devastating fires. And whether this is going to be sort of back to normal, if you will, this year, relative to what you put on last year?
I won't say back to normal because I don't think any of these shows are normal. The size and scale and scope of the artists and the staging and all the things that happen to put the show together is always unique and exciting. Last year was extra challenging, but we've not been short in challenges. We had COVID, we've had other issues, we've had fires, we've had rains. So this show will be different. It will be focused on the music and celebrating music. I'm really proud about last year's show, though, to be honest. We raised almost $25 million for music people who needed help around the fires and their loss. That money's all been distributed, short of just a very small amount. So proud of what we were able to do last year. Excited about this year's show. It's going to be very different and fun.
How important are the Grammys to the artists themselves? I mean, obviously, most of the people who win are, they're already wildly successful, which is usually why they won. But do artists sort of really get a big boost, by carrying home those awards after the night's over?
Just a nomination, to be honest, can create a really large boost for them on their streaming numbers, for their touring numbers. We've done some different economic studies, and the numbers range, so I won't say a figure, but the fact is the attention, the notice, and the excitement around different artists is evident, and it's definitely extending their opportunity to do other performances, monetize their streaming. And it's not just the stars, to be honest. You mentioned all the famous people. You see Kendrick Lamar there. It's 95 categories across multiple genres. We're honoring hundreds of people that are, and it's subjective, but they're being deemed the best in their class for any given year. All those people, classical, jazz, rock, pop, reggae, jazz, we have awards for all of them, and they're all receiving the awards. They're all getting the benefit of receiving the awards and getting the respect of their peers in the community, and that's the difference. These are peer-to-peer voted awards.
Well, you mentioned that there's a lot of newcomers, and certainly I want to get to those, but let's talk about some of those stars. Kendrick Lamar leading the nominations. I believe he has 9 nominations in total. Lady Gaga also, of course, a household name here. So there's a lot of familiar faces when it comes to, the leaderboard, at least when it comes to the nominations.
Definitely, and that's what makes it so exciting. You're seeing a lot of really great diversity in the general field categories. You mentioned a couple of them, but with Bad Bunny and others, there's a wide range of different styles of music. You also have great, fresh newcomers. We have some icons and some legends, today's superstars. That's a beautiful combination that's going to make for a great show.
And, you think about some of the newcomers here, just going through the list. I see Addison Rae there, Cat's Eye, Somber. I also see the Marias here. So when it comes to, the best new artist nominees, how does this field compare to maybe years past?
I think it's incredibly exciting. Again, you have different types of music and you have different types of artists. To me, that's going to be a spectacular thing to see on our show, and whoever wins this category will be so well deserving. But the other nominees, I think, are incredible stars going into the future.
You have a partnership, obviously, with CBS and Paramount with regards to the broadcast and streaming of this. I am curious, Harvey, as you look long term, I mean, the Oscars just struck a deal that I think was 2029 or something. They're going to be permanently going through YouTube for the live broadcast. Do you envision that most of the award shows are going to follow that same path?
Hard to predict. Everybody has their own, journey, their own vision of what they think is best for their show. For us, we've just agreed to a new partnership with ABC, Disney, and Disney Plus. That will start after this show, so our very next show. I do think there's an opportunity to reach more people in different platforms, and everybody's going to be looking to do it in the way that their audiences are looking to be served. We want to go to where music lovers and fans of music are consuming their content, and we'll continue to look at that. Where everyone else decides to go, it's hard to say, but we are going to be at ABC Disney for the next 10 years.
All right, Harvey, really great to get some time with you. That is Harvey Mason Jr. He is the CEO of the Recording Academy.
Yeah, I just want to say, Trevor Noah is the host.
I do.
Sixth time. I was just looking at the stats here. There's only one other person, right, who hosted more than him. That was Andy Williams, who hosted 7 shows. John Divern was 6. And then LL Cool J, who hosted 5 times, which I didn't know that. No. And I love LL. Yeah. Andy Williams was a little before my time. But all right, we got to set you up for what to watch when we come back after the break. This is Bloomberg. We cap up a busy week and push ahead to an even busier week. Monday, you get a bit of a reprieve. Paris Fashion Week kicks off a delayed U.S. durable goods report. But Tuesday, that's when things really kick into high gear with the slew of earnings.
Yeah, big time. Earnings from GM, JetBlue, American Airlines, and Boeing, which is exciting. A good read there before we really gear up for some big tech earnings.
Yeah, then on Wednesday, we start to get Meta, Microsoft, Tesla, IBM, Starbucks also set to report that day on a Wednesday, which we also should point, coincidentally, is Fed Day.
Yeah, that is going to be a fast and furious afternoon. Looking forward to Wednesday. Thursday, then, in terms of the earnings, we get Apple, Visa, MasterCard. We also get U.S. jobless claims and trade balance on the eco front.
Yeah, but it looks like it is going to really be earnings driving this. We get a lot of those big oil and gas companies reporting on Friday, including Chevron and Exxon. It'll be interesting. We're also going to get American Express on Friday morning. Could it read there, given some of the things that transpired this week on the credit card front?
Yeah, a lot of questions for those card companies.
Absolutely. And I'm told we might get an announcement of who the next Fed chair will be. Balance of power, they're up next. This is Bloomberg.